Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky. We have Aron Pinson on the line. He is a CFA, co-founder and chief investment officer at LPS Financial LLC. And he's also the author of the MicroFundy blog. We're going to talk fundamentals with Aron. How you doing this morning?
I'm doing great, Joel. How are you?
We're doing good. Welcome back on the show. First, let's talk about Netflix. I know you're going to talk about it from a fundamental standpoint. Boy, oh boy, the street is just loving this stock. All the upgrades, all the price target raises. Coming in earnings on Wednesday, kind of a bold move. What do you think?
Right. So Netflix is something which I actually wrote about just a couple of months ago about why the stock is really so volatile. And I think this is really the key factor to focus in on, where, if you're looking to trade different types of stocks out there, there's more fundamental, slower moving type of companies, whether they're consumer staples, healthcare names typically, things that don't really have so much variability tied inside of them. And then Netflix is really the other side of the extreme. You have so much volatility inside of it, and I really wrote this post explaining why. And I think now we're just seeing, that the part where, the euphorium, the excitement on the company versus, let's say, certain times during last year where you saw, the other side of the coin with Netflix. Just some, to throw some numbers out there, Joel. During a 4-month stretch in 2011, Netflix was down about 80%. In 2013, it was the best performing stock in the S&P 500, up over 250% just in 2013. And then during last year, there was one period between March and May, the stock was down about 35%. There was a mid-year rally of over 60%, and then towards the end of the year, another 35% decline. And so far this year to date, Netflix is the third best performing stock in the S&P 500. The only two better performers were two companies that had major deals. Obviously, Kraft was one, and then Hospira, the other one, being purchased by Pfizer, announced earlier in February. So to see Netflix up over 40% year to date, it's something you want to look at and really try to understand why it's so volatile. And that's a post I wrote back, again, in the beginning of February, where Netflix is really the epitome of leverage. Okay, there's not only financial leverage, which I'll get to in a second, but first and foremost, there's the operating leverage of their business model. I think it was Mark Andreessen that just a couple of quarters ago, I think towards the middle of last year, came out and said that he thinks Netflix could end up having 1 billion users eventually, sometime down the road. You're talking about possibilities of huge amounts of generation of revenues and profitability down the road. And if you think about their cost structure, most of it is fixed. They get those content, and they have to pay, obviously, billions of dollars for not only their original programming, but to license other people's movies and things like that. But once they purchase that content and license it, for the most part, that's a fixed cost. And then whether they get 1 million subscribers or 40 million or eventually 100 million or more subscribers, that's something where that just adds to their business almost straight to the bottom line. The variable cost inside the business model is very, very little. So that's number one, first and foremost, in leverage, where, if you think that one day they'll have hundreds of millions of subscribers, obviously that could ramp up and, create one of the highest and best performing companies in the world, versus if it obviously goes the other way and, loses a lot of subscribers. And then also there's financial leverage. And even though, their balance sheet doesn't look that bad initially, if you look at it first blush, they have a little less than $1 billion in long-term debt before their last debt issuance of $1.5 billion. They do have a couple of $1 billion in equity and $7 billion worth of assets. It doesn't look like there's that much leverage there. But when you look a little bit deeper, you see that a lot of their assets on their balance sheet is intangible assets. Content, they can't really necessarily sell their licensed content to other people to liquidate and to get cash or things like that. And they also have tremendous amounts of off-balance sheet debt that doesn't really come onto the balance sheet, where they can't really come out with the exact amount of money due for a lot of this content that they acquire. So they have to put it on a separate a line item off their balance sheet on their filings, which that would add a tremendous amount of leverage. So to keep a long story short, you're talking about, when you look at the actual tangible balance sheet of the company, you're talking about $1.6 billion in cash, only $2.6 billion in tangible assets, and they have over $11 billion of real liabilities when you count the content liabilities, you count all the other liabilities as well. So not only do you have that operating leverage from their business model, but then of course you have the leverage from their financial leverage, and combine those two together. There's no wonder why the stock is so volatile during good times, during optimistic times, whether it's from analysts, whether it's different comments from investors like Carl Icahn about the company or Mark Andreessen. People are looking long-term, big picture about how big the company could get and have that euphoric phase inside of it. Next thing you know, these targets and the analysts' targets get ramped up. I've seen bull cases of saying the stock could be worth $1,000 a share, and it's based on real fundamental valuations. But then you have to know, getting involved in anything like this type of company, again, probably the most volatile company in the S&P 500 over the last several years, that this can go exactly the opposite way as well. And if you do have some sentiment shift, this is a name that could, come back not only very aggressively, but very sharply as well, and cause a lot of pain for investors.
Well, there's a lot of expectation here, but there's upcoming earnings here. You had a lot of analyst upgrades, price target raises. This is even before the numbers. So if I'm reading you correctly here, has it gone a little too much, too fast? I mean, how would you be sitting if you were long the stock? Let's say you bought it an earnings play and it's run $70 here. I mean, do you wait? Do you sit it out? Do you wait? Because right now the expectations are so high that if they come in line or already beat a penny, they're gonna crush this thing. What's your take after this big run ahead of earnings?
Right. So first off, definitely, I'm not. When you look from a short-term oriented trader, that's not something I really have that much of an opinion on. To play a game of earnings is definitely not my forte.
Okay.
To try to time the investment. But having said that, if you look definitely at option prices and straddles and things like that, you do see that implied volatility, and the pricing of an earnings play in Netflix is always one of the highest out there. So to see the stock up or down 15%, 20% on an earnings announcement is definitely something which you can expect, especially after a strong move like this. So to answer your question more directly, if I were long, I would be hoping and praying for the best. But earnings plays and things like that is definitely not my forte. What I would say is, over the longer term, any investor, any person that owns Netflix has to know part of their philosophy, part of their investment policy statement, part of their overall portfolio build and how it correlates with other investments. You just have to know why it's so volatile. Expect the volatility going forward. As long as they have that financial leverage, if they issue tons of stock, sort of de-risk that balance sheet, raise equity, lower their debt, lower their liabilities. And perhaps, if their operating model ever changes, where maybe some of their costs they move on to subscribers somehow, and then they shrink the leverage from an operating perspective, then maybe you can think of this company as a more stable. The point that I just want to highlight and understand with Netflix, that people should understand, is know what you're getting involved in. This is a volatile company. It's going to stay volatile, and whether it's in a short term in earnings, 100%, you could definitely expect a large move. But especially over the longer term, as I've highlighted with some of the numbers over the last few years, to see even on longer swings and over several months or several quarters, how you can see this either being the best or the worst of the overall markets over certain periods of time.
Let's move over to another issue here, kind of the opposite end of the spectrum, a lower price stock, Groupon. Been in a trading range for quite some time here, coming off the $7 level. Turned out to be pretty good support, running into some resistance, $7.50. Give us your long-term outlook for Groupon.
Right. So Groupon had some news today where investors are speculating, and there's been some reports out there from sources that KKR is looking to purchase one of their business divisions, Ticketmonster, or become an equity holder, maybe buying close to 60% of it. Groupon is tremendously interesting from a perspective where they had a major shift in business models over time, where this company, for a period of time, was one of the largest, or I should say, fastest growing companies in the world. I think it was the fastest to $1 billion in revenues from any company in the history of since anybody has ever tracked these type of metrics. But most of their revenues initially came from that third-party revenues, where if you look at what the business was what typically people think of when they think of a Groupon, whether it's a restaurant, whether it's a hotel, a certain spa package, or what have you, where they would have tremendous amounts of margins. They never provided actual service to customers. They just took a cut, a very significant cut from the restaurant owner or from the cleaners or what have you, and that part of the business was what they tried to scale, but unfortunately they couldn't. Initially, when they raised money and went public, people were saying how Groupon, what they did for certain smaller areas, whether it was initially in Chicago and then branched out to other, very, prominent locations, and they were going to bring this out worldwide and try to scale this type of business. And they hired tens of thousands of employees, and they were going to ramp this up and bring this type of model and leverage going forward throughout the world. That was the hope, and if they were able to do that, and if the business model was scalable and somehow, success in a small local area was able to be duplicated to many areas or more areas throughout the world, that would have been tremendously beneficial, and the business model obviously makes tons of sense. There's really not any any major obligations for the company other than just attract customers to local businesses, and they never had to provide any service and just get a cut for everybody's revenues. That business stalled, though. It peaked in, if you look on a trailing 12-month basis, it peaked towards the middle and end of 2012 and has declined from a revenue perspective and sort of stabilized over the last couple of quarters. But, if you look at where it was, you're talking about close to $2 billion on a trailing 12-month basis back in the third quarter of 2012. And if you look at what it's doing now, it's about 1.6, 1.7. So it obviously has stalled and sort of stabilized over the last couple of years. Instead, all the growth of Groupon, what people started looking at, and as far as the money they were generating as far as revenues, came from this Groupon goods business, which was a direct business, sort of them being in competition with Amazon or Buy.com or Overstock.com, where they would sell actual goods, discounted goods, directly to consumers. And now, in this sense, they would have to actually purchase the items. They would have to go and go into fulfillment business, similar to Amazon, ship the items, take the risk of transacting the items, logistics. You're talking about a totally different business. And as you probably can imagine, Joel, the gross margins of the initial business, the third-party business, were in the high 80%. You're talking about 85, 86%, even till today. The other business, where you're talking about mid to high single digits, it hasn't ever really gone above 10%, and that's just on a gross margin level before any operating expenses and other expenses come in as well. So that's a shift that Groupon really started portraying and saying, hey, you know what? We're going to grow our revenues, and they wanted investors and analysts to focus, look at our revenue growth, look at our business, what we're generating. That keeps on growing, and this Ticketmonster was part of that. And it seems like maybe with today's announcement, and maybe with what they realized over the last a couple of quarters, is that this direct business maybe isn't necessarily the best place to go into. Perhaps liquidating some of the parts of the business and really focusing on their core. Maybe that's where they want to get back into. But what I would say is that Groupon is definitely not in the best place going forward. It never has been, really, as once they figured out that this third-party business is not something which can be scaled, a niche business, and something that they can do in a couple of local areas, that's great. That's a great business to be in, and they have the brand name. Obviously, Amazon tried it with Living Social, really hasn't done anything. They can continue to milk that business and generate those high 80 margins. But if you look at once that failed to scale, really Groupon just seems, sort of like dead in the water. Nothing really to do on the upside, and any type of revenue growth is not going to be. It's not going to come with any margin expansion. That's for sure, because it's definitely coming from that lower margin direct business with the Groupon goods overall.
Yeah, not going to be sustainable. Before we let you go, you did a blog a little back on interest rates and bonds with negative interest rates. You're like buying tulips or rare earth stocks here. So give us your look. I mean, the Fed's been really wishy-washy as far as, interest rates going up. Along with talking about bond yields here, what's your outlook for interest rates for the remainder of the year?
Right. So to be clear, definitely not an economist, and I'm not going to make a prediction on interest rates, although I would say, like I wrote in the blog, where if you're buying interest rates with negative interest rate, you're buying a bond with a negative interest rate attached to it, again, that is something where you have to be buying it in hopes to selling it to someone else. Even if you have billions of dollars to park somewhere, and you're worried your currency might decline, no matter what the reason is of why you want to buy a negative yielding bond, it has to be that within the time frame of when you're purchasing it, it has to be well before maturity that you're looking to sell the actual bond at even a further negative yield, or which obviously would equate to a higher price to another buyer. So when you look at tulips, or you look at some rare earth companies, or a lot of these momentum stocks without any rhyme or reason behind them, where people are just buying a stock symbol and a stock price as opposed to an actual business with fundamentals. Those type of investments, if you want to call them investments, or those types of trades, have been known to be called greater fool trades, where there's always going to be a greater fool that you're going to try to sell it to afterwards. So if you want to buy tulips back during that tulip craze, or you want to buy a rare earth stock, which back several years ago went up, I think it was 500 or 1,000%, without really any basis or fundamental reason of why these companies should be worth what they are. It was just because, hey, you know what, in a month from now, in a quarter from now, a few weeks from now, I might go and sell that actual tulip, or I might sell that rare earth stock, or some of these 3D printing stocks, or what have you, during each of these crazes of the period of the market time that they were in such demand, and sell it to that next greater fool. And it's obviously not to the same extent, but all these investors or traders that are buying, whether it's 5-year or even in certain occasions 10-year, let's say, Swiss government bonds, even with the currency fluctuation, if you're buying a negative interest rate security, you have to be looking to sell that higher before maturity, because you could hold the money in cash, switch the currency out, purchase another currency. There are better alternatives. You could even hire some custodian somewhere to hold your cash in a vault. You'll pay less than the 10 or 20 basis points of the negative interest rates that you'll be paying the actual Swiss government that's issuing that bond. So all I'm saying is that, not that it's wrong, and not that it won't go lower and go into more negative territory, and you'll make money flipping it. But know that it's a flip. It's not an investment. Nobody's buying a 10-year negative interest rate security to hold it through maturity. That's all I'm saying. I'm saying that they'll go and they'll buy it today, hoping to sell it next month or next year, or for protection or for some kind of hedging, but they're not holding it to maturity as a typical bond investor would do. It's more a bond trader, more on a technical basis, where they're buying looking to sell, as opposed to buying looking to invest in the asset itself, backed by cash flows, backed by certain metrics and things like that.
Excellent point. Aron Pinson, CFA, co-founder and chief investment officer at LPS Financial LLC, joining us here on Benzinga's Pre-Market Prep, talking fundamentals. We appreciate it, Aron. We hope to talk to you again soon.
Thank you so much, Joel. I appreciate your time.
All right.